For this mock exercise, we're going to take a look at a company called Travel Warehouse Limited. It's a merchandising operation, and we're going to look at how to record the purchase and sale transaction. Let's take a look at the question. So Travel Warehouse distributes suitcases to retail stores and extend credit terms of N30 to all customers. That means that the customers all have to pay at the end of 30 days for any credit terms extended to them. At the end of June, Travel Warehouse inventory consists of 40 suitcases purchased at $30. So this would be the beginning inventory for July accounting period, and they're $30. It uses a perpetual inventory system. So that's important to know because we just saw in previous videos that it matters how which system of inventory management the company uses, perpetual or periodic, that will dictate the different types of journal entries required. During the month of July, the following transactions occur. So these are all the transactions. We're going to look at each one in detail in a minute. Let's look at the required or the instructions. Record the July transactions for travel window. So we're going to take a look at all of these transactions. We're going to actually post the transactions to a merchandise T account and calculate the July 31st balance. And then we're going to calculate the average cost per suitcase at the end of July. Okay, so let's look at the first transaction. It says purchase 50 suitcases on account for $30 from trunk manufacturing terms N30. So what I like to do is I like to keep track of what's happening with the merchandise inventory. So I think what I'll do is I will have a T account here, okay, called inventory. Okay, and I'll put down the word July 1st here. And remember it says we had 40, right? 40 times 30 is $1,200. That's my beginning balance. So I like to put down inventory in dollars, and then I might want to do inventory in quantity. So 7-1, we had how many units? We had 40 units, okay? So what I want to do is I want to track the dollar inventory values and the quantity. Okay. Now, on July 2nd, so let me write down July 2nd, the entry is, again, perpetual inventory. We're going to debit inventory for 50 times $30, and we're going to credit accounts payable, and that's $1,500. So on July 2nd, I want to write down here 7-2, we have 1,500, and 7-2, we bought 50 units. Okay? Now, July 3rd, what does it say? Receive $150 credit from the trunk manufacturing after returning 5 suitcases because they were damaged. So we got $150 worth of credit. So the entry is, this is July 3rd, debit accounts payable for $150. We got a credit, and credit inventory for $150. Okay, because it says we receive $150 credit for 5 suitcases. And of course, it would be 5 times $30 gives us $150, right? So I'm going to put July 3rd, $150 here. And July 3rd, I'm going to take away 5. Okay, because that was a return, right? Now, on the 6th, it says, sold 40 suitcases on account to Satchel World for $55 each. So on the 6th, we need to record two sets of entry. First, we're going to debit accounts receivable for the 40 times the 55. That's $2,200. And we're going to credit revenue for the same amount. And we're going to update the cost of goods sold, because that's the point about perpetual. We're always updating the inventory and cost of goods sold at each purchase and in each sale. So debit cost of goods sold, I'll just short form as COG. In this case, because the average cost of these suitcases has been $30 per suitcase, then we're going to take 40 times $30, which is the cost, right? That gives me $1,200, and we're going to credit inventory for the same amount. So here we're going to credit, so 7/6, July 6, 40 units. And we're going to also credit 7/6, $1,200. Okay? Now what's next? July 7th, it says issued 275 credit for 5 suitcases returned by Satchel. So when we sold it to our customer, we gave them a credit to return 5 because they were wrong color. The suitcase will return to inventory. So again, there's a two-step transaction here for July 7th. So what are the two-step transactions? First of all, we need to debit revenue. But it's actually not revenue, right? We're going to debit a contra account called revenue or sales return and allowance. Because we want to keep track of total revenue and total returns and total allowances. Because we need it for management and control, planning and control purposes. So in this case, the amount of return is the credit of $275. Okay. And we're going to credit accounts receivable, $275. In addition, we're going to also update our merchandise inventory. So debit inventory, credit, cost of goods sold. I'm going to short form COG. In this case, 5 will return, so 5 times $30 gives us $150. So again, it's 7/7. We return 5, so we're going to subtract 5. Oh, sorry, in this case it will be on this side, right? Because we got 5 back into inventory. And we need to debit $150 here. See how easy it is for me to make that mistake? Because, again, you need to pay attention whether we're bringing back inventory in or we're selling. In this case, we are bringing back into inventory. So, okay. Now, what happens on the 13th? Sold 30 suitcases to another company called The Going Concern Limited for $55 each. Okay, so that is July the 13th. Okay. Sold inventory, it would be, again, debit accounts receivable. And we sold 30 times $55. And by the way, and I always like to put the calculation beside the account that I'm using, just because it reminds me of how I came up with that number. $1,650, I'm going to credit revenue. And again, I need to debit cost of goods sold and credit inventory to reflect the fact that I've sold a whole bunch of inventory. And it was 30 times $30, which is $900. So this is 713. Take away 30 units. Okay, and inventory, 713, take away 900. Okay? Now, the next part, it says paid 50 freight to save truckers for merchandise purchase from holiday manufacturers. So we paid some sort of a freight company for any goods that we purchased from holiday manufacturers. So in this case, we're going to debit. So I'm going to do it here. This is July 17th. Okay. Because we're using perpetual inventory system, I'm going to debit inventory for the freight cost and credit cash, which means that I need to debit my inventory for the freight cost. Okay? And the 27th says receive payment in full from Satchel World. Because there's no discount, right? I don't have to worry about whether they fall within the discount period. So I need to reflect the payment. So it's going to be debit cash, credit accounts receivable, but how much? Well, remember, Satchel World owed us $2,200 on July the 6th, and they returned $275 on July the 7th, so that's $1,925. And then it says paid truck manufacturers for the balance owing. So that one there was on July 31st. So debit accounts payable, credit cash. Again, we're not entitled to any discount of some sort. So how much do we owe Trucking World? Well, we bought inventory on July the 2nd for $1,500. And we were returning $150 worth. So that is $1,350. Now, we managed to update the inventory and the quantity, so we don't, again, it's a good idea to constantly do that. So you'll see that altogether, the ending inventory on July 31st should be the culmination of all the inventory transactions. Oh, I forgot one transaction. Sorry, I forgot the 16th, didn't I? I did the 17th, and so I forgot the 16th. It says purchase 60 suitcases from holiday manufacturers and 30 FOB shipping point. So I forgot to include that in there. So let me take an opportunity to include that. Okay, on the next page. So July 16th. We need to record debit inventory. That was $1,800. And credit accounts payable, $1,800. So let me add that in here. So July 16th is right here. It's $1,800 here. And then July 16th here, we need to add how many units was that? 60 units, right? So altogether, this should give me 2,450. That's my ending balance. And this should give me how many units? So it's got 40 plus 50 minus 5 minus 40 plus 5 minus 30 plus 60 gives me 80 units. Okay? So if I was to determine the per unit cost, which is one of the questions asked in Part C, so the per unit cost is going to be $24.50 divided by 80. And that gives me $30.63. Now the reason why that's not equal to the $30 per unit is because we need to add the freight cost. Because remember, freight adds to the cost of that inventory. And we need to accumulate all costs of inventory, particularly if it's a cost incurred to get the inventory to the place of business. Okay, so to answer the first part C, it says what is the average cost for these suitcases? It's now $30.63. Okay, so why it says average amount not equal to the amount per suitcase, which is $30? Because we're adding the freight cost. Remember that $50 freight cost? We're adding that in there, which increases the per unit average cost. All right, thank you.